Okay, let's dive right into this. Welcome to today's Explainer, where we're unpacking the really fascinating, kind of complex story of ProAssurance Corporation. Now, if you follow the specialty insurance sector, you already know this company has been navigating some seriously choppy waters lately. But here we are in the summer of 2026, and they're literally standing on the precipice of a massive transformation. So, we're going to look closely at their financial health, their pretty aggressive strategic pivot, and the monumental upcoming merger that's poised to change the whole shebang.
Here is our quick roadmap for today's Explainer. First, we'll meet ProAssurance. Second, tackle their stagnant revenue. Third, explore their profit over growth discipline. Fourth, dig into the merger strategy. And finally, track the road to closing.
Section 1. Meet ProAssurance, Niche Dominance.
So ProAssurance is a national leader in medical professional liability insurance, holding an A rating from AM Best. But right off the bat, notice this core conflict. On the one hand, AM Best gives them a favorable business profile for their solid market position. But look at the other side. Their operating performance is rated as just adequate. And why is that? Well, their actual underwriting results have been consistently unprofitable for 5 years straight, lagging way behind the industry average. Basically, they're writing business, but claims and expenses are eating up more cash than the premiums are bringing in.
Looking at their footprint, their specialty property and casualty segment covers a massive spectrum. We're talking physicians, dentists, chiropractors, entire hospitals, and surgical centers. They even stretch into medical tech and life sciences, ensuring folks who run human clinical trials. Plus, they've got a workers' comp arm just for added diversification. It's a huge, complex operation. And you know, when you're insuring everything from a local chiropractor to a high-stakes clinical trial, managing that risk is an incredible high-wire act.
Section 2. Stagnant revenue and headwinds.
Now, what's really interesting about this is how they're handling their revenue hurdles. They are in a totally defensive posture. Just look at that 0% figure. As of June 2026, ProAssurance has a 0.00% dividend yield. For a mature financial holding company, that's a glaring signal. It points straight to cash flow strain and a management team that is in absolute capital preservation mode. They're hoarding every single dollar, prepping the balance sheet for the heavy lifting of a major merger rather than handing out cash to shareholders.
Digging into their Q1 2026 filings reveals a really fascinating dynamic. Look at the top line. Gross premiums written actually dropped by 5.5% to about $287 million. They're intentionally writing less business. But then, drop down to net investment income. That's up over 8% to nearly $40 million. And because of that investment income, along with some favorable prior year reserve development, their net income literally skyrocketed from a nearly $6 million loss in Q1 2025 to an $8.5 million profit in Q1 2026. The big takeaway here? The core insurance ops are shrinking, but their investment portfolio is absolutely keeping them afloat.
And just a quick note to reassure you, every single data point we're digging into here is grounded in undeniable facts from their official Q1 2026 10-Q filed with the SEC. For this explainer, we rely on hard data. We're tuning out the market noise and going straight to the source.
Section 3. Profit over growth discipline. When you're staring down unprofitable underwriting and flat revenue, you really only have two choices, right? Chase top-line revenue to look bigger or shrink to survive. ProAssurance chose to shrink. They implemented what the industry calls rate adequacy discipline. In plain English, this is the strict practice of just walking away from business, new or renewals, if the pricing isn't high enough to cover the insanely elevated severity of medical malpractice claims we're seeing right now. Management consciously decided to suppress revenue growth to stabilize the book and build long-term earnings resilience.
So the crucial point is that underwriters have strict pricing gates now. Look at the evidence. In Q1 2026, for the clients they actually kept in the Specialty P&C segment, they pushed renewal premiums up by 6%. Cumulatively, they've pushed rates up more than 80% since 2018. That's massive. Naturally, when you jack up prices that aggressively, folks leave. That's why their overall segment retention dropped a bit to 83%. They're intentionally shrinking the book to purge the bad risks.
And we can actually see this discipline starting to move the needle in their consolidated combined ratio. In the insurance world, a combined ratio over 100% means you're operating at a loss. So, at 110.4% in Q1 2026, yeah, they're still losing money on the actual insurance they write. But look at the progress. That's a solid 5-point improvement from the 115.6% they reported the year prior. Their strict discipline, combined with those favorable reserve developments, is slowly but surely stopping the bleeding.
Section 4. The merger strategy.
Now, rate discipline is great for stopping the bleeding,
But it doesn't cure the underlying disease, which is needing more resources in a brutally tough market. The ultimate resolution? M&A, acquiring greater capabilities. As ProAssurance CEO Ned Rand perfectly framed it, joining forces with the Doctors Company will allow them to serve healthcare providers with the necessary scale and breadth of capabilities. Scale is the magic word here. By merging into the Doctors Company, which is this massive California-based reciprocal inter-insurance exchange, they finally get the sheer size needed to weather the storm of elevated claims in this market.
And this brilliantly illustrates just how committed they are to making this happen. Follow the money. Looking at their condensed consolidated statements of income, you'll see $1.4 million in pre-tax transaction-related costs in Q1 2026 alone. And that's right on the heels of $7.1 million spent in Q1 of the previous year. They are putting serious capital behind this integration. It's a massive neon sign to investors and employees that this combination is for sure their definitive path forward.
Section 5, Road to Closing.
Let's move to the timeline and see how this builds, because the momentum is real. This whole thing started back in March 2025 with a definitive agreement. By June 2025, shareholders overwhelmingly said yes to the deal. The very next month, the FTC granted early termination of the antitrust waiting period. Then came the long, tedious slog of state-by-state insurance approvals, leading us right up to today. On June 23, 2026, they announced the final regulatory hurdles were cleared, paving the way for an expected closing date of June 26, 2026.
Just look at the sheer web of jurisdictions required to greenlight this thing. They needed nods from Alabama, Washington, D.C., Illinois, Missouri, Texas, Vermont. They even had to get sign-off from Lloyd's of London and the Cayman Islands Monetary Authority. Because, hey, nothing says American healthcare liability quite like a Cayman Islands review, right? But the final, crucial puzzle pieces that had everyone holding their breath were the pending reviews in California and Pennsylvania. With those finally secured in June 2026, the path is entirely clear.
So, what does this all mean? It leaves us with one massive, ultimate question to wrap up this explainer. Will this merger with the Doctors Company finally reverse the tide of elevated claims and stagnant growth to unlock ProAssurance's true value? They've already proven they have the discipline to walk away from bad business. Now, as a newly scaled insurance giant, they actually have the size to compete on a totally different level. It's a textbook pivot. Watching how they perform on day one of this new era is going to be absolutely fascinating. Thanks so much for joining me, and make sure you keep your eyes on those filings.